All right. Today is Tuesday, January 4th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight. And let's start by this. I tweeted in the morning, a 1.7% handle on the 10-year yield this fast will rattle the market. Complacency will be met with a rude awakening. And we discussed over and over in this channel that if yields start to rise higher, specifically on the 10-year, you're gonna see chaos in the market, specifically in the technology, high growth, high momentum, specifically high multiple kind of stocks. And this is exactly what we got today. We will explain it all in the heat map analysis. Yet the delusion from the Wall Street pumpers, the criminals, continues. For example, they say that Apple stock will continue to grow faster than the economy. Really? Faster than the economy? What world are you living in? Or better yet, what kind of stuff are you smoking? Here's what I got to say about this. The biggest surprise that will catch most market participants off guard is when they realize that the majority of the growth in 2020 and 2021 will probably never be replicated again. The stimulus resulted in insane revenues and profits for a company like Apple, but that was the peak. What do I mean by that? Think about it like this. Be it Apple or Nike, when we look at the results, the financial results of the company, we're seeing a slowdown in revenue growth from regions like China, for example. But that was substituted by massive growth, insane growth from revenues in North America. Why? The answer is the trillions and trillions of stimulus. That was a transitory increase in the purchasing power of American consumers. But now the stimmies are gone. They ran out and consumers dipped into savings. And now the savings rate for households is below the pre-pandemic reading. So what is the next step? The next step is racking up debt by using credit cards. And we're seeing credit card debt rising, or shall I say, surging higher rapidly. What happens after the consumer already exhausted all of their reserves to spend, all of their purchasing power? How are we going to replicate the growth, the revenue and profit numbers from 2022 and 2021 where we had pretty much insane purchasing power in the hands of consumers? A better way to look at it is this. The government was buying iPhones and iPads from Apple in 2020 and 2021. How do you expect the consumer's purchasing power to match up with the government's purchasing power? It will never happen. And therefore, 2020 and 2021 was the peak for earnings growth. We will never be able to replicate these numbers, at least in the near term. It will take years before these companies organically grow to match these numbers from 2020 and 2021. And therefore, all of these propagandists will say that the consumer is doing great. Don't worry about the Fed raising interest rates. That doesn't matter because the consumer is doing great. The consumer is powerful and corporate earnings are going to continue to grow. Absolute delusion, and you're in for a rude awakening. But let's move on to the main topic of the day, and here it is. In focus tonight, a crisis in the White House. An inflation crisis that is morphing into a political crisis, and there is panic in the White House as Joe Biden's poll numbers drop like a rock. Complete collapse. And why is this happening, by the way? The reason is we have inflation surging out of whack, like we've never seen before. Specifically for millennials and Gen Zers, they have never seen inflation like this before. This is the highest inflation and the fastest growing inflation in almost 40 years. Take, for example, the average price of a used vehicle, not a new one, now averaging at $29,000. This is more than the annual income of many Americans. Low-income Americans. Absolute insanity. And this is, of course, being reflected in the approval, or shall we say disapproval numbers for President Joe Biden. His disapproval numbers have reached new highs, specifically when it comes to the economy. 60% of Americans, once again, 60% of Americans, the majority, disapprove of President Joe Biden's job on the economy. How could they not? The supply chain crisis is worsening. Inflation is all around us. You cannot deny it anymore. Even if you're Stevie Wonder, you're seeing inflation. And adding more fuel to the fire of inflation is the complete madness and restrictions, which are causing essential workers to quit and many of them pushed to retirement. Specifically when it comes to the trucking industry, the supply chain disruptions could increase as truck drivers quit in droves due to COVID concerns. The mishandling of the virus crisis, the mishandling of the economic crisis. You combine both of them together and you have the perfect storm to produce such low and abysmal approval numbers. Folks, we're not done here with this inflation crisis. We are just seeing the beginning of this inflation monster. For example, you and I know that we use chips in pretty much everything we use these days, and we have a severe shortage of chips globally with no relief in sight whatsoever. Matter of fact, the waiting time for chips has now reached all-time highs above 25 weeks, adding more to supply disruptions and wait time to receive products. When the demand is sky high and the supply is scarce, this is a perfect recipe for inflation and for prices to continue to rise higher. Adding more pain to the misery, today we got news, bad ones, from ASML, one of the largest manufacturers of chips in the world, because they had to shut down their manufacturing operation in Germany due to fires. And by the way, what is causing inflation? What is the real reason behind inflation? I think we entertained that answer many times in this channel, but here it is. If you think that the imbalance between supply and demand is due to the virus, you better wake up now, because we've been in a pandemic for almost 2 years now. And we had phases of lockdowns and reopening, yet inflation continues to rise higher regardless. And the reason is, as Dr. Milton Friedman taught us, inflation is always a monetary phenomenon. What does that mean? The source of inflation is always the Federal Reserve. The Federal Reserve ushered the tsunami of liquidity in response to the pandemic, and the purpose was to prop up the equities and real estate markets in hope that will keep the economy afloat. The real intention, you and I know that, is to prop up the equities market and the real estate market to push the assets of the wealthy and the rich higher and higher, using the pandemic as an excuse to unleash that tsunami of liquidity, trillions and trillions and trillions of dollars. When you overstimulate an economy with excessive money printing, you're gonna produce inflation. And inflation is a self-sustaining phenomenon. Once it's born, it can continue to feed within itself and grow larger and larger and larger. And there are severe limitations of the monetary policy and the fiscal policy specifically in controlling inflation after it's born. And the only remedy to cure inflation, this is at least from history, what we learned from history, is aggressively raising interest rates higher, which could produce a recession. In other words, a recession could be the remedy for inflation. Bad outcome either way. And what did Joe Biden do, by the way? He renewed the tenure of Jerome Powell, the tyranny of Fed Chairman Jerome Powell, the tyranny of quantitative easing, the tyranny of low interest rates, the tyranny of assets purchasing programs to prop up equity prices higher to benefit the rich, meanwhile push other assets prices higher like housing and food, causing homelessness all over the country and killing the American dream of owning a home, crushing the purchasing power and the quality of life of the poor and the middle class. Instead of firing Powell and saying, you know what, you failed at your job was price stability, you produced the highest inflation in almost 40 years, goodbye, we're going to hire somebody who's more competent, who's going to do the job right. Instead, Biden renewed the tyranny of Jerome Powell, the incompetency of Jerome Powell. And instead of rushing to action, Jerome Powell remains delusional, aloof, sanguine, whatever word you want to use when it comes to this inflation. First, he said it's going to be transitory. Well, we now know it's not transitory. So did he taper all of the assets purchasing programs producing this massive inflation? Of course not. He said he's going to do it in increments. He's going to be finished with the tapering program in March. And then we're going to talk about raising interest rates. What does that mean? The Fed is way behind the curve and the inflation crisis will worsen. Regardless of the tricks, regardless of the releases from the Strategic Petroleum Reserve to push energy prices down, regardless of the variants they're going to release, regardless of price controls and any other tricks, inflation will come back better, stronger, and more vicious than before. And this is a global phenomenon, by the way. Today, we got the data from Canadian factory prices, and these prices are rising at the fastest pace since 1974. Look at this chart. If you thought that inflation is peaking or that we've seen the worst of this crisis, think again. We're just starting here. We're getting closer and closer to match the peak of inflation in the 1970s, the worst inflation crisis in the modern history of this country. Look at inflation numbers in Spain, for example, jumping 6.7% annually, the highest since 1989. Matter of fact, inflation in the Eurozone has reached all all-time highs. These are record highs of inflation, numbers that we've never seen before. And again, the source of this inflation, this global inflation, is the central bank of the world, the Federal Reserve, and the incompetency and misguided policy of the Fed led by Jerome Powell, adding fuel to the fire, the incompetency of the fiscal policy led by Joe Biden. Today, we got data that a record number of Americans are quitting their jobs. Matter of fact, 4.5 million Americans quit their jobs in November, adding more pain to the misery of the labor shortage. Good luck finding labor if you're an employer, specifically a small business kind of employer. You gotta hike these wages up, and higher than you expect, because an interesting phenomenon is the number of quits is surging higher. The number of job openings, on the other hand, remains at all-time high. We still have more job openings than those looking for a job. Yet that number ticked down in November. What does that mean? We have a lot of employers who are giving up on finding employees. They've been looking for weeks, perhaps months, and they cannot find employees, so they're not looking anymore. And of course, there is a lot of misconception here that employees are sitting at home, cashing government checks, and this is the reason behind the labor shortage. That couldn't be any further than the truth. Because the truth is, when employees get a job offer and they look at the salary or the hourly pay, they do the math and it is not worth it anymore. If they take a job, they're actually losing money net. Whatever they're getting paid, when you equate that and pin it against inflation, they're actually losing money because time is money and they're better off doing something else with their time rather than settling in for a wage that doesn't live up to inflation. 55% of former hospitality workers say they're not interested in returning to the industry because of low pay, and 39% say they won't return because of lack of benefits, according to a Q3jobless.com survey. And here is the reality, folks. Yes, average hourly earnings went higher. Hourly earnings are growing by 4.9% on annual basis. On the other hand, inflation is rising higher on a faster pace. Inflation at 6.2% on annual basis. And this is, by the way, the cooked number, the tamed down number. The real inflation number, if you factor in rent prices, is anywhere between 12 and 15%. So even with higher wages, and by the way, they're not really that high than the pre-pandemic levels, but even with that, you're actually net losing money. Inflation has eroded all wage gains in this economy. And listen to this, even U.S. troops will receive a pay cut. Yes, a pay cut in 2022 when factoring inflation, because they're getting a bump of 2.7%. On the other hand, inflation is surging higher by at least, and this is the minimum, the cooked number, 6.9% on annual basis. Even troops who put their lives on the line to protect the country, they're getting a pay cut. They're getting punished by this inflation. Not the military-industrial complex, the contractors and the criminals. I bet they're not getting a pay cut at all. They're getting a massive pay raise. And this lack of competency and failure in policy is spreading all over. It's not just in the economic front, but also in the virus front. We're seeing cases reaching all-time highs. They told us by Christmas, it's going to be over. We're going to be back to normal. What do you know? This couldn't be any further than the truth. On top of that, even when it comes to the fiscal policy, the Build Back Better plan, the affordable health care, the child care assistance to make sure that poor families can live up to the cost of inflation. Well, that's not happening anymore because the talks already fell apart before the year even started. And now, today, when Senator Manchin was asked, did you talk to the White House about renewing the talks of Build Back Better? Manchin said, I don't know what they're talking about. Nobody talked to me. And folks, this is becoming a full-blown economic crisis in this country. And this is being reflected in the new poll that we got today from CNBC. Stunning numbers. We've never seen bad numbers like this before. Take a look.
Good morning, Andrew. Yeah, President Joe Biden's approval rating slipping sharply into negative territory in the third quarter. CNBC All-America Economic Survey, as Americans soured on his economic leadership, lost some confidence in his handling of the coronavirus, and they grew increasingly concerned about the inflation and supply shortages that show up in our poll. Biden's approval rating fell from 48% last quarter to 41% now, and disapproval rising 7 points to 52%. So those numbers, put them together, they put Biden's net approval rating 11 points underwater. His economic approval now 14 points negative. He still has a positive rating on his handling of the coronavirus, but that's declined as well. Still +5, though. Compare with other presidents at the end of their first year, Biden just slightly above where Donald Trump was, but well below Presidents Obama and Clinton, not showing Bush there. He had this huge rating following 9/11 at this time. These numbers come after a quarter that saw a surge in the virus, a surge in inflation, the rise of labor and supply shortages that our poll shows Americans have clearly noticed, and an agenda that stalled in Congress. Just 43% of the 800 respondents support a Democratic-controlled Congress. That compares to 41% looking for Republican control. 16% are unsure.
And look at this chart, by the way. Even with all the failures of the Democrats so far, voters are not that excited of switching parties by allowing the other criminal party, the Republicans, to take over. Matter of fact, a lot of Americans now are dissatisfied and disapprove of both parties because both parties have been placing the interest of Wall Street, the rich, and the corporations ahead of average working Americans.
Democrats, they need a 5 to 10 point lead in this measure, and because of the political map, they need a lead that large to maintain control. Biden and Democrats, they're clearly going to have to change the economic outlook to turn these numbers around, and they have a lot of work to do. 46% say they expect the economy to get worse in the next year. That is the worst level in the 13-year history of the poll. Very surprising to me.
And again, look at this. 46% of Americans say that the economy will get worse in the next 12 months. So we continue to hear this bullshit narrative from the pumpers and the Wall Streeters saying that the economy is going to be great once the variant is over. You're going to see splurging in the economy. The consumer purchasing power is high, yada, yada, yada. Meanwhile, 46% of Americans say that the economy will worsen in the next 12 months. The contrast between Wall Street and Main Street could not be any clearer than this. And listen to what Steve Leisman says in answering the next question. Very important. Take a listen.
The rise in the cost of living, now seen as the biggest concern in the country, tied with the coronavirus. 60% of Americans say they've noticed supply shortages. Andrew?
So, what was the biggest surprise to you? I mean, you just mentioned that item, but
I'm surprised at how negative things are. And honestly, Andrew, we sit here in this little sort of bubble that we're in of the stock market. We see the stock market's up and it's high and it's doing okay. And Americans clearly are hurting by this inflation and by supply shortages.
Right.
And that has turned their views sharply negative. I expected to see negative numbers. I didn't expect to see some of the worst polling numbers that we've registered in the 13 years that I've been doing this every quarter.
Bingo. Bingo. And by the way, I cannot believe that Steve Leisman still has a job at CNBC. Be prepared to hear, oh, Steve Leisman is down with COVID. He took a break, right? Because he said we are in a bubble here. When we look at the stock market every day, everything is hunky-dory. The economy for the rich is working great. We see all-time highs in the stock market pretty much every single day. Last year, we had 70 all-time highs records for the S&P 500. On the other hand, 46% of Americans say the economy will worsen in the next 12 months. And inflation is going to get worse because companies across the board are hiking prices, be it Mondelez, be it General Mills, be it Campbell Soup, be it Clorox, be it Procter & Gamble, be it Kimberly-Clark, be it any other company. They're hiking prices. And the reason is inflation. They're paying more in input costs for commodities and products, transport costs, and they're shifting that extra input cost all the way down to us, the end consumer. Folks, this is not a surprise. This is the nature of inflation. You and I, the end consumer, are going to bear the brunt of the pain, not the corporations. The corporations are going to pay more, then they're going to pass that extra cost down to us. And any competent corporate leader will do the same. You have to stay ahead of inflation if you're leading a company, specifically a consumer product kind of company. You cannot take Jerome Powell's word for it that inflation is going to be transitory. You have to hike prices higher to stay ahead of inflation, and therefore inflation becomes a game of expectations. If the corporations are expecting higher prices, they're going to push these prices higher, whether the Fed says it's transitory or not. Then the consumer is going to pay more, and the consumer is going to expect to pay more, and it becomes a cycle, a vicious cycle, a self-sustaining cycle of inflation where prices continue to grow and get higher and higher and higher. Now, viewers of this channel know the limitation of the fiscal policy in combating inflation. We made a video about the 1970s and the failure of price controls by President Nixon and the failure of whip inflation now by President Ford and the failure of the austerity measures by President Carter. The only thing that worked in killing inflation in the 70s is the Volcker approach by Fed Chairman Paul Volcker, legendary Fed chairman, who hiked interest rates significantly higher until inflation got crushed, but that produced multiple recessions. It took multiple recessions to destroy inflation. So pretty please, somebody pass the note to our politicians today, because it doesn't seem that they have a grasp. They think that they can combat this inflation by creating more inflation. Meaning, here's the headline from the New York Times: Democrats blast corporate profits as inflation surges. Politicians are placing more blame on greedy companies as prices stay high, but booming consumer demand is enabling firms to charge more. Now here's the problem. There is no such thing as booming consumer demand. The booming consumer demand is fueled by stimmies and fake cash. Once that is washed out of the system, you're gonna see that the consumer is an emperor with no clothes. The problem with this inflation is not the supply, it's not the demand. The problem with this inflation is the cocaine. What is the cocaine, by the way? It's the cocaine coming from the Federal Reserve, the funny money printing, the trillions of dollars to prop up the equities market. That is the cause for inflation. And inflation is never going to go away without an adjustment of policy from the Fed. Think about it like this. If you are a company, Procter & Gamble, for example, your input cost is increasing because the materials that you have to buy to produce your products, well, those prices went higher. The price of the commodity that you use in your product went higher. On top of that, the transportation costs also went higher, and the reason is we have higher energy costs, gasoline prices, etc. We also have wage inflation. You have to pay those truckers and those employees manufacturing the products more in wages. Now, if you don't increase prices, your margins are going to get crushed, and when margins get crushed, the company produces less profits and less revenues. When that happens, they're going to have to get rid of employees to reduce the cost to the company. So what they do is pass that extra cost all the way down to the end consumer, you and I. And of course, companies are taking advantage by not just passing the extra input cost, but then some to us, the end consumer. Why not? Why not take the advantage? If the consumer remains receptive with fake money, fake cash printed out of thin air, why not seize the opportunity and push prices even higher? Push it to the limit to increase your revenues and your profits. This is the nature of this capitalist system, whether we like it or not. But here comes your beloved politicians. Take, for example, Senator Warren, who we praised in this program many times when she said and did the right thing. Not in this instance, for example. Warren is targeting supermarket chains over high food prices. What are they supposed to do? Are they supposed to lose money when they have to pay higher wages, higher input costs, higher energy costs? How come Senator Warren, she called Jerome Powell a dangerous man. I gave her a lot of credit for that. But how come Senator Warren never called for the Fed to end the quantitative easing policies? How come Senator Warren never said to Jerome Powell, you gotta taper all assets purchasing programs, you gotta raise interest rates, and stop crushing this economy to manipulate the stock market higher, only to make the rich richer? How come she never said that before? And here comes President Biden. President Biden is now targeting U.S. meat firms to tame surging prices. Biden believes that if he spends billions of dollars in aid to so-called smaller competitors to the big meat packing companies, this will reduce prices. This could not be any further than the truth, folks. And Larry Summers, by the way, called this out, that this is delusion. This is not a remedy to inflation. This will cause more inflation. And here's why. Back in the day, we used to have butcher shops. You go to the butcher and you buy your meat fresh. Not anymore, because we had the meat packing industry, the food industry, who bought politicians to create red tapes and regulations to make it really hard for butchers to operate. And that consolidated the industry in the hands of very few companies. Add to that the fact that these companies are facing inflation costs, be it energy costs, be it labor costs, be it input price costs for machinery and equipment. And on top of that, we have COVID restrictions. If anybody gets a case, they have to go home and quarantine, and that reduces the supply and the production while the demand is still hot. The imbalance continues to cause inflation in prices. Instead of curing all of that, they decide to spend billions of dollars on so-called small individual meat packing operators. Now, these players in the industry will use the cash, the free government cash, to compete for the same machinery, for the same labor that the big guys are competing for. What is that going to produce? Higher wages, higher prices for machinery because we have a scarcity of supply. The end result will be higher meat prices. So this is yet again another misguided policy. Rather than solving the source of this inflation by having somebody competent as the head of the Federal Reserve who is going to tame this inflation by adjusting the monetary policy. And yes, the price for crushing inflation could be a small stock market crash, could be a small period of a recession, but that is the remedy for inflation. The longer you wait to act, the worse it's going to get. But they cannot do any of that, folks, because God forbid the stock market goes down. And now, what do you know? They gave the memo to the rich, and you have corporate insiders and the rich dumping stock like never before. So now they're paving the way to adjust the monetary policy. After the rich already dumped their stock, and who's left to hold the bag, by the way? The retail investors crowd. When they raise interest rates to tame this inflation, the stock market is going to crash on the top of the heads of the mom and pops chasing the lottery ticket, not the rich. The rich already cashed out. What they're going to do is they're going to buy the dip once the crash happens and accumulate more assets at a cheaper price. Nice game, isn't it? And then just to illustrate the lack of touch from the Federal Reserve to what's going on with inflation and average Americans. Today we heard from the demon from Minneapolis, Neil Kashkari, one of the most arrogant and delusional Fed presidents in history. Neil came out today and said, inflation has risen higher and lasted longer than I expected. Oh, really? You think? This is Neil Kashkari back in November. Kashkari says Fed should not overreact to temporary inflation, so it's not temporary anymore. Right, Neil? After you already tipped your buddies, the rich and the insiders, to dump stock because you're going to raise interest rates higher now. And here's Neil. Neil says he supports 2 interest rates increases this year to counter risks posed by inflation. And of course, over the weekend he started bitching and moaning about his Airbnb on Twitter. Hey Neil, your criminal policies are causing evictions, a tsunami of evictions in this country. It is stripping away the new generation of millennials and Gen Zers from the American dream of owning a home. We have millennials in their 40s who have to continue to rent and have roommates, even though they work a job, perhaps 2 or even 3 jobs. But with this insane home price inflation, and you have corporations and wealthy individuals, by the way, scooping single homes across the country to turn them into rental properties. This is killing the American dream. Most people cannot afford a home anymore, yet you're bitching and whining about your Airbnb. And just a reminder, by the way, this is Neil Kashkari defending the criminal policy of the Federal Reserve. Listen to his logic, or shall we say lack of logic. Here it is.
In our conversation, Kashkari was quick to dispute the criticism that the Fed is really just boosting financial markets and helping Wall Street.
There is this idea on Wall Street that the Fed kind of has our back, and that because you may have well-intentioned policies that are trying to get everybody to work, there is this side effect, this unintended side effect of just kind of really helping the rich.
That argument ignores the benefit to the poor. And if you're going to ignore the benefit to the poor, then we're only helping the rich. But of course, that's an incomplete analysis. When you actually sit down and say, well, let's go through the trade-offs of the choices that the Fed has, whether it's interest rates or it's quantitative easing, it's not just about Wall Street. It's not just about asset prices. It's also about thinking about the men and women in America who are trying to find work and who want to have higher earnings and who deserve higher earnings. If we are benefiting them by helping them find work and helping them have higher wages, I will take that trade-off.
Hey, Neil, how about this trade-off? Economists warn of inflation inequality as poor get slammed by rising prices. How about this one, Neil? Only 17% of workers say their pay has kept pace with inflation. Once again, only 17% of workers say their pay has kept pace with inflation. This is the trade-off that Neil is talking about. He says, yeah, we're propping up the assets of the wealthy and making the rich richer. On the other hand, some of that is trickling down in the form of jobs and higher wages for the rest of you bums. Neil, the trade-off is not even happening. The only impact your stupid policies doing is making the rich richer. That's all there is. And today Neil comes out and says, the economic recovery is well underway but has been uneven. Oh, you think? You think it's uneven? What about the trade-off? And by the way, the worst part of this inflation, Neil, is food inflation, the global famine we're about to see. The starvation that we're about to see, or shall we say we're already seeing it right now, Neil, which could morph, by the way, into a geopolitical problem. For example, we have a hunger crisis in North Korea due to a food shortage. Now, this guy has nuclear weapons. What do you think he's gonna do when he looks around and his people are dying all over the place, or perhaps turning against him because they're hungry, they're starving? He's gonna start a war. He's going to start bombing something. And you don't have to look at North Korea, by the way, Neil. Look at the UN gauge for food prices. We are getting closer to a record high. Now, here's a reminder for you. The last time we saw these readings in the UN Food Price Index was around 2010-2011. What do you think happened back then? The answer is the Arab Spring and the massive chaos that followed thereafter. And again, you don't have to look at the Arab Spring or North Korea. Look at this country, the richest country in the world, the United States of America, Neil. We have a hunger crisis in this country, a starvation crisis in this country. The headline reads from Bloomberg, hunger stuns growth of American babies as inflation hits hard. Underfed children are falling behind the growth curve in some high-risk areas, while other families turn to cheaper, less nutritious food to fill up. Both will have lasting impacts. Mr. Kashkari, go ahead and tell these families and these babies that the trade-off is worth it, that making the rich richer is worth it. Here's another headline from NBC News. I cannot even afford to buy a cart of groceries, quote unquote. Spiraling inflation leaves some grocery workers struggling. So when you go to the grocery store and you think you're suffering by paying more, look at the workers around you. They are suffering. They cannot even afford the grocery in the store they're working for. And here's some more sobering news for you. Prices will continue to keep soaring in 2022 because whatever the Fed does, there is a lagging impact. We're going to continue to see higher prices. They're going to have to be even more aggressive, which will cause a massive market crash and perhaps a destabilization of this so-called great economy. And let's conclude with this. Neil Kashkari, this is the trade-off. Forbes estimates this is Elon Musk. Well, Forbes estimates that his net worth now stands at over $300 billion. This is more than the GDP of countries. I bet his kids are not starving, and God bless, he is a successful entrepreneur. But the problem is, this is an illustration of the failure of the system, the failure of these misguided policies, and the insane financial engineering of the economy by the Federal Reserve. You make one guy insanely rich, so much money he doesn't even know what to do with. The guy's going to Mars, perhaps another universe, while we have kids in this country starving and going hungry. This is the trade-off. Anyhow, I apologize, folks, if this is too intense. I usually try to keep it light and funny, but how could you not be serious when this is going on? But anyhow, we're moving on to cover the market information today, starting with the performance, and here we go. The Dow Industrial Average closed in the green by 214.59 points, or a gain of 0.59%. The Nasdaq, a big down day here, by 210.8 points, or a decline of 1.33%. The S&P 500 pretty much in the flat line by 3.2 points, or a modest loss of 0.06%. What about the performance of the different sectors of the market today? Leading the pack at number 1 and capturing the gold medal, energy. Number 2 for the silver, financials. Number 3 for the bronze, industrials. The laggards of the day led by healthcare, technology, and communication services. The theme is clear here. The inflationary stocks are rising higher. Value stocks are outperforming. On the other hand, the stay-at-home stocks, the growth, momentum, high multiple, tech, they're not working, they're not performing. And the reason is the massive pop that we got in the 10-year yield. What about the advanced decline ratios? NYSE 64% advancing versus 34% declining. The Nasdaq 40% advancing versus 57% declining. Not a bad breadth overall, and therefore you're seeing the S&P 500, for example, closing on the flat line. The majority of the pain is in the Nasdaq and the big cap, the high momentum, high growth kind of names. Moving on to futures, commodities, what's going on here? We start with energy. Crude oil prices continue to move higher. What's new here? Gains of a little over 1% for both the WTI and Brent. Brent is going to read 80 really soon. Gasoline prices moving higher. Heating oil prices also moving higher by a little over 2%. 2%. On the other hand, natural gas prices are down by a little under 2%. We have some news here for the energy market. Perhaps this is done by design, by the way. All of a sudden, the Venezuelan output of crude oil is moving higher, despite U.S. sanctions. If I put my tinfoil hat on, is this done by design to drop inflation down? Could be. We're also seeing natural gas prices, electricity prices shooting up higher in the Northeast, specifically New England, and the reason is the massive storm that they're experiencing right now. We also have more news in natural gas, perhaps the reason behind the drop in natural gas prices, at least for now. The U.S. output is now the largest for liquid natural gas, surpassing both Australia and Qatar. You got to keep in mind, though, the tensions between the U.S. and Russia. How much longer can we supply Europe with liquid natural gas via boats? At some point, we got to find an agreement between Russia and the United States to settle this dispute. Otherwise, we're going to see a war between Russia and Ukraine, and this will cause a massive surge in natural gas prices. Back to the futures. What about softs? What's going on here? Gains, for the most part, led by coffee. Massive gains for coffee here. Gains of over 4% in a single day. Likewise, we're seeing gains in cotton, lumber, and OJ. On the other hand, sugar pretty much in the flat line, while we have losses for cocoa futures. We have surprise raindrop in the Ivory Coast, and this is boosting the production of cocoa, and therefore we're seeing a modest drop in the prices of this commodity. What about metals? Excellent day for metals. Gold, silver, platinum, copper, palladium, all rising higher, despite the prop of the 10-year yield. Are you noticing this trend or not? Really interesting. We know that the 10-year yield is an enemy of gold. Every time it surges higher, gold drops down. Not the case today, and I bet that this relationship will change, and therefore gold will be a top performing commodity in 2022. What about meats? We have a down day across the board led by feeder cattle futures, lean hogs, and live cattle. On the other hand, we have gains across the board in grains, whether we're talking about soybeans, soybean meal, soybean oil, corn, wheat, rough rice, oats, canola, all moving higher today. Moving on to the big casino, the options market. What's going on here? Leading the pack at number 1, Ford. We got the news today of boosting the new pickup electric truck, whatever it is, doesn't matter. Ford is a top performing stock here. The migration from high multiple stocks to value stocks, specifically undervalued stocks like Ford, is happening right before our eyes. And therefore Ford, by the way, outperforming all other manufacturers, even Tesla. Tesla's gains for 2021 were about 50%, Ford at around 150%, tripling the performance of Tesla. But anyhow, here it is, Ford at number 1 with about 1.5 million contracts. About 75.5% of those were calls. At number 2, Apple with about 1.1 million contracts. About 63% of those were calls. JP Morgan at number 3, surprisingly so, with about 900,000 contracts. About 93% of those were calls. Again, this is due to dividend paying, which is going to happen tomorrow for JP Morgan. They sell a lot of calls, expecting the stock to drop. But be careful here, because we're seeing financials outperform as the 10-year yield surges higher. What's going on with the unusual activities that took place in the options market today, starting with the ticker AFRM, Affirm. The buying calls here for more upside, the 95 calls for the expiration date, February 18th, with the expectations that the name will pop higher by more than 10% by then. They paid about $7.75 a piece to enter this trade, all in all spending about $13.5 million. What about the ticker SKYY? This is not the vodka, by the way. This is the cloud computing ETF. The buying puts here because when rates move higher, it dents the valuations of software stocks because they enjoy high valuations. This is justified under a low interest rate regime, not under a high interest rate one. And therefore, they're buying the 95 puts for the expiration date, January 21st, with expectations that the name could drop down by more than 6% by then. They paid about 70 cents a piece to enter this trade, all in all spending about $550,000. Continuing with interesting trades, what about the ticker ADY for analog devices, chips? The buying puts here, the 162.5 puts for the expiration date, January 21st, with expectations that the name could drop down by more than 7.5% by then. They paid about 75 cents a piece to enter this trade, all in all spending about $500,000. What about the trade for the ticker WDAY Workday, another software name. They're buying puts here, the 235 puts for the expiration date, January 21st. With the expectations that the name could drop down by more than 7% by then, they paid about $2 a piece to enter this trade, all in all spending about $1 million. What about the ticker NVDA, NVIDIA? They're buying calls here, the 315 calls for the expiration date, January 14th. With the expectations that the name could pop higher by more than 7.5% by then, they paid all about $2.80 a piece to enter this trade, all in all spending about $1.4 million. What about the trade for the ticker DISCA, Discovery? This is a value name. It's on the top of my list, by the way. I have calls. If they expire in the money, I will own the stock. Somebody's buying the $30 calls for the expiration date, February 18th. With the expectations that the name could pop higher by more than 12% by then, they paid about 75 cents a piece to enter this trade, all in all spending about $375,000. What about the ticker mRNA, Moderna? They're piling up here. We're talking about the shorts. They're piling up on Moderna by buying the 210 puts for the expiration date, January 14th, with expectations that the name could drop down by more than 10% by then. They paid about $3 a piece to enter this trade, all in all spending about $1.5 million. What about the trade for the ticker SEC Limited? The buying calls here, the 210 calls for the expiration date, January 7th. Betting on a rebound here by a little over 6% by the end of the week, they paid about $1.15 a piece to enter this trade, all in all spending around $500,000. What about the trade on the bottom of the table for the ticker IR? This is for Ingersoll Rand. This is an industrial name for air compressors, and it has been one of the top performing stocks last year. This is one of the kind of stocks that are unloved, that are not sexy, the old school kind of stocks, but they also happen to be value, and therefore they're outperforming the market so far. But somebody's fading the rip here by buying the 55 puts for the expiration date, March 18th, with the expectations that the name could drop down by more than 9.5% by then. They paid about $1.25 a piece to enter this trade, all in all spending about $550,000. Continuing with interesting trades, what about the ticker TSLA, the souffle? Massive bets here, be it calls or puts. In this case, it is a put, the 1,150 puts for the expiration date, this upcoming Friday, January 7th, 3 days till expiration. They paid about $27 a piece to enter this trade, all in all, spending about $75 million. Unbelievable. What about the trade for the ticker DDOG, Double Dog, or Data Dog, excuse me? They're buying calls here. My bet is somebody, a holder, a top holder, is selling calls to raise cash here. The 165 calls for the expiration date, February 18th, with the expectations that the name could drop down if you're selling those calls, of course. They paid about $11.50 a piece to enter this trade, all in all spending about $11.5 million. Moving on to the heat map analysis, what's going on here? The inflationary stocks that tend to outperform when yields pop higher are doing exactly what they're supposed to do. We're talking about financials, we're talking about energy, industrials, materials, defensives, the value names, they're all outperforming. Now, what's underperforming? Names that are sensitive to interest rates. When interest rates pop higher, utilities, REITs, they don't perform so good. Likewise, the high multiple names in biotech, in technology, software, communication services, the Chinese names, even name like Tesla, a high multiple name, underperformed today. But notice the contrast even within technology. For example, IBM, Oracle, VMware, Dell, all the old school names, the value names outperformed today, with the exception of Cisco, of course. We talked about Cisco yesterday, the trade, buying puts because they're paying dividend, and the stock is already overbought. Technically speaking. What do you know? Cisco is down about 3%. So if you followed me and you bought puts, salute. But let's talk specifics here. We have an upgrade for GE, and therefore General Electric is moving higher by more than 3% today. We also have an upgrade for Coca-Cola. And Coca-Cola is moving higher, one of the top performing stocks here, by about 1.6% today alone. These are the kind of stocks that are going to continue to outperform. Old school, good value, good dividend. These are the kind of stocks that you want to be in when interest rates are moving higher. On the other hand, we have a down day for a name like Nutrien, NTR, which I praise all the time in this channel, down a little over 5%. And the reason is we have the CEO abruptly leaving. Nutrien did not offer any explanation whatsoever. And I said on Twitter, they owe us an explanation for us who happen to be shareholders of Nutrien. Why did the CEO abruptly leave? And then when we look at the automotives, look at the contrast here. The high multiple names, Tesla, NIO, the Chinese names, Lucid, underperforming tremendously. On the other hand, the value names, Toyota, Honda, GM, Ford, tremendous outperformance today. We have some good news for Ford, for example. They are doubling the production of the new electric pickup truck, the F-150 Lightning. Who knows if this product will be a hit or a miss, but the increase in production is a positive piece of news. We talked about Ford, the top performing stock in the automotive sector in the stock market, even beating Tesla. When it comes to Toyota, we have good news for Toyota, and therefore Toyota is surging higher today. The stock is up over 6%, and the reason is Toyota dethroned GM to become America's top-selling automaker in 2021. That did not hurt GM stock, by the way. GM is moving higher because the theme is appreciate value and let go of overvalued stocks. Let's take a look at the ETF heat map to see if we have a theme here or not. Once again, look at value outperforming growth, be it the VTV or the IWD outperforming the VUG and the IWF. The theme is clear. Energy outperforming, materials, industrials, financials. The inflationary sector of the market is moving higher. The disinflation sector of the market, the high multiple kind of sectors in the market like biotech, severely underperforming today. Likewise, we're seeing chips and technology also underperforming. Moving on to charts, starting with SPY, 30 minutes chart. What's going on here? We have a gap and crap, not a bad one. We did not close at the lows of the day. And the reason is the SPY has oil, has industrials, has financials, materials, all the sectors that are working in the stock market right now. So expect the outperformance of the SPY versus the Qs to continue so long as the yield on the 10-year continues to move higher. On the other hand, if the big caps start to melt, then even the outperformance of financials and energy will not be enough to hold the SPY. Apple, Microsoft, Tesla, Nvidia, Google, Facebook start to melt down, and the SPY will visit 470 as support sooner or later. But so long as the big caps are muted, not down by much, then you will see the SPY outperforming the Qs. And here's a daily chart with a continuous contract on the SPY, the S&P 500. Again, the bull flag pattern continues. The momentum indicators are still positive, but what is negative here? The win for the bears today was the volume. The volume surged higher on a down day. This is one positive sign for the bears. What about the Qs? 30 minutes chart. What's going on here? We talked about 397 as the center of gravity. It pulled the chart down and then it pulled it higher again to close exactly at around 397. This is going to continue here because 397 is the center of gravity. It will act exactly as 313 before. The problem is if interest rates continue to move higher, I don't know if the center of gravity will be enough to keep the chart from falling down further, specifically when the big caps start to melt. Let's follow up on a trade that I had right after Christmas, or before Christmas, I should say. I said that I'm buying puts on the Qs or initiating a short trade at around 397. So batch number 1 happened at 397. What do you know? The Qs moved higher. And then we had the pattern, the resistance, making lower highs. On the third lower high, it became evident to me that we will visit 397 sooner or later again, so I initiated batch number 2 for that particular trade, buying more puts. Batch number 3 will take place if we have a confirmation of a rejection at 397, meaning if the Qs open down tomorrow, far away from 397, then we'll know right away that the chart got rejected from 397 and therefore I will initiate batch number 3 and that will complete the trade, and we will wait till expiration date, which happens to be March. Now, in all likelihood, the trade will be closed before March, the expiration date, if we see a flush down in the Qs. But this is how you construct the trade, on increments, because you'll never get the timing right. So you have to open your trades on increments. And this is exactly how I do it. Now, let's take a look at the daily chart for the continuous contract for the Qs. What we're doing right now is retesting that sloping line of resistance, now supposedly support. We're retesting this one as support. We came close in the previous candle, but it did not retest that level exactly. Today, we retested that level and closed above it. Is that enough to conclude that the Qs are positive? Because it is a positive formation. It is a bull flag formation. Not really. We have to see a confirmation. Another day, a bounce higher tomorrow will confirm the sloping line of support is solid. However, if we open down tomorrow, losing that support and perhaps revisiting 15,975, then you'll know the bears are starting to take the advantage here. The momentum indicators remain positive, but they're curling down, and look at the volume blasting higher on a down day. The bears are turning the tables here. What about the IWM? We're seeing multiple false flag formations. I shouldn't say that because that's going to trigger the robot police. But we're seeing false bear flags formations. They work for a little while, then they pop higher again in a gap and crap. But the evidence is clear here. The chart is struggling to pop higher. It is waiting and waiting and waiting for buyers. The buyers are not showing up. Sooner or later, if this behavior continues, you're gonna lose 223 for support. Not interested in buying this one right now. I gotta wait and see how the IWM performs after retesting 223 and preferably 218. What about the Dixie? What's going on here? Still trading above 96. The negative divergence is still here in the RSI, but it is getting weaker, meaning we're trending positive now. What is supporting the Dixie for now is the weakness in other currencies and the demand for the US dollar, for example in Turkey, where the lira is weakening significantly. Despite all the push from Erdogan to buy the lira, the Turkish population is not buying it. They're actually hoarding the dollar. And this is supporting the value of the Dixie to move higher. This did not impact gold negatively, by the way. Gold moved higher despite an update for the Dixie and the 10-year yield. This is a positive sign for the old man. Really good sign for gold here. And let me say this. Let's zoom out and show you this. This is a weekly chart. You see the trend line and the false breakout. This is an incorrect analysis. And unfortunately, I'm seeing this in many other YouTube channels, many other analysts. They're using this to say that gold is negative because we had a false breakout and therefore you're going to see gold trending down. Here's a classic mistake that many technical analysts fall into, including myself, by the way. I'm not perfect. When you have a spike top or a spike bottom, that is the end of the previous trend. And now you start a new, fresh trend. You don't draw your trend line from the spike top or the spike bottom, because that is the end. That marks the end of the previous trend. You wait for the new trend to form, a fresh trend to form, and then you draw your line. If you draw it that way, you can see that we knocked once, twice, a third time, perhaps this is the fourth time on that particular sloping line of resistance. But we're making higher lows, and therefore the formation is positive, and sooner or later you will see gold popping above that line. This is the assumption, of course. There are no guarantees in life. And here's the chart of the 10-year yield. What's going on here? We got close to 1.7%, and this is what's rattling the NASDAQ and the technology high multiple corners of the stock market. It is not the number, 1.7. It is the velocity of how fast we got from under 1.5% to almost 1.7%. A gigantic move in a short amount of time. This is what's rattling the NASDAQ. Let's assume that this continues because the momentum indicators are still strong and we get to 1.7 by the end of the week. Boy, we're going to see more pain in the NASDAQ here. And here's a chart, a weekly chart for the TLT bond prices. It is abundantly clear right now that the TLT is trading down and losing the support of 149, paving the way for those of us who say that yields are going to pop higher, not bond prices. And by the way, we saw the third biggest outflow in the history of the TLT. Ask yourself a question, is this bullish or bearish? This is absolutely bearish. Yet we have geniuses online who continue to tout that bond prices will pop higher, the TLT will pop higher, etc., etc. The Fed will never raise interest rates. What a load of garbage. And here is the VIX 4 hours chart. What's going on here? It is muted, it is tamed, but look at the MACD indicator. It is still trading positive. The RSI is bottoming and starting to move a little higher. Sooner or later, we will see a pop in the VIX, perhaps to revisit 20 and retest that for support. It is resistance for now. We have to pass it and retest it for support. Now, the SPY is holding good, and therefore the VIX is not popping higher. On the other hand, the VXN, the VIX for the NASDAQ, this is a 4 hours chart for the VXN, is popping higher. And look at the MACD indicator. It is crossing to positive territory, creating green impressions in the histogram. Is this bullish or bearish for the VXN? It is bullish, which means we have more pain to come in the NASDAQ. Every time you have a crossing in the MACD creating green impressions in the histogram, we see double-digit gains in the VXN. And here's a weekly chart for the VXN. We've already broken the sloping line of resistance, and now we're retesting that line for support. What does that mean? If the support is confirmed, we're going to see a massive pop in the VXN, which will mean a massive drop in the Nasdaq. And here's a 5-minute chart for Apple, just to illustrate the rejection that we saw today from two lines. Line number one, 182.6, which happens to be the 3 trillion cap line. Apple tried to pass that line multiple times in the morning, and it failed. And then went down to retest 182.15 as support, then as resistance, and got rejected from that line and flushed all the way to the end of the day, consolidating in what it appears to be a bearish formation. When we switch to the daily chart, as you can see, the selling came at a higher volume. It is not a reversal candle yet because we have yet to reverse the gains from yesterday. But look at the momentum indicators. They're already elevated. They're curling down. Sooner or later, we will see Apple retesting 172.4 as support and perhaps closing the gap at 165.32. What about Tesla, the souffle? 30 minutes chart, what's going on here? It tried to hold on. Look at these numbers, by the way. I have 1,209.7 that acted as resistance, and Tesla failed to close above that line. Then it retested 1,174.5 as support. It held on for a little while before failing that line, and then the rest is history. We have the bear flag, and if the bearishness continues, we will revisit 1,090.5 for support and then take it from there. Tulips, what's going on here? Don't touch it. Leave it alone. We have a bear flag. We have selling on higher volume. This is not a good sign. Leave it alone until the retest of 42,000 happens. And lastly, what about AMC? What's going on here? Oh boy, losing the support of 26, but getting really oversold. From an our side perspective, this is the 30 minutes chart, of course, and therefore we saw some buying by the end of the day, yet not closing above 26. The week is still young, you have a lot of time to close above 26, but the message for the apes is, are you really enjoying this? This is not entertaining, and it is too stressful. On the other hand, we're seeing other stocks, boring stocks, like Ford, for example, popping higher. You're better off getting the memo and migrating from risk on to risk off. And lastly, before we move on, for the GMA crowd, the GameStop crowd, I hear you. You want me to do an analysis. I will do that in tomorrow's video. The charts and the fundamentals for GameStop. I don't have enough time to do that today, so I will do that tomorrow. But here we are. We're moving to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the ADP employment report. This will be extremely important. And then we have the services PMI. We got the manufacturing. What a disaster that number is. It is showing a slowdown in the manufacturing sector of the economy. If services is slowing down too, we got a major problem, perhaps a stagflation problem. But most importantly, we have the FOMC minutes. A lot of action will happen tomorrow, so buckle up your seatbelts. And with that, ladies and gentlemen, I'm done here. Thank you for listening. Thank you for watching. This is all I got for you for now, but I will talk to you again tomorrow.